written hundreds of articles covering variety of issues in tax, corporate law, constitutional law, and general laws in both the print as well as digital media. Sir has just completed his book on taxation of digital economy, which covers wide ranges of issues such as international tax and indirect tax aspects, which is expected to be released soon. Sir is also the chairman of the expert committee on GST, Madras Chamber of Commerce and Industry. Sir is also the member of Finance and Taxation Committee, Confederation of Indian Industry, Southern Region, and Vice President of the Revenue Bar Association. We warmly welcome you, sir. Our next panelist is Sri V.N. Dubey, sir. Sir is an advocate by profession, primarily practicing at the MP High Court and having regular appearances at the Supreme Court, NCLTs, NCLAT, and tribunals across the country. Sir holds an experience of 30 years in the field of corporate and tax laws. He is a fellow member of the Institute of Company Secretaries of India and law graduate from the University of Calcutta. Sir is also qualified insolvency professional. Sir provides consultancy, advisory, litigation services to various central government departments, state government departments, public sector undertakings, banks, as well as corporates. Sir also happens to be the senior standing counsel for Income Tax Department and Central Board of Indirect Taxes and Customs at the Madhya Pradesh High Court, and Sir regularly represents the Income Tax Department, GST Department, Customs Department, Directorate of Revenue Intelligence, and Directorate General of Goods and Services Tax Intelligence at the High Court level. Apart from all of this, Sir, being the founder of a firm, JMVD Legal, has always been a source of guidance for all of us. We warmly welcome you, sir. Now I may introduce Sri Leeladhar Maheshwari, sir. Sir is the chairman of RCM Group, which is a leading group of the city engaged in real estate and infrastructural activities. Sir has completed his LLB from DAVV University and the city. Sir ventured into the real estate in the year 1998 and has since played a key role in shaping the firm as one of the most trusted and leading developer of the city. Sir is the current chairman of Credai Indore chapter and is one of the leading figures in the real estate business of the city. As an active member of the real estate community, Mr. Leeladhar is a key figure to take up many policy issues on real estate with the government in the city as well as for the state. Sir is also a board member of many religious trusts in the city, and Sir is an active figure in the local community. We warmly welcome you, sir. Our next panelist is Sri Madhav Tulsian. Sir, being a partner of a firm at JMVD Legal, heads the indirect tax division. Sir is a fellow chartered accountant and tax practitioner with an experience of over 10 years in the field of direct taxes and indirect taxes. Sir has previously worked as a manager in the finance department in the multinational corporation ETG Parogate of Africa for an experience of over 4 years. Sir routinely provides consultancy and advisory services to many public listed and large conglomerates of India, and as well as these conglomerates are present abroad. We warmly welcome you, sir. With this, I will leave the podium for Sir Amit Dubey for initiating the discussion further and moderating what promises to be an enriching panel discussion. Thank you.
Thank you very much, Amol.
Thank you, sir.
So today we are here for the panel discussions on the issues pertaining to issues of GST under JDA. JDA is full of issues, but we will be restricting ourselves only to GST. And in this regard, we have just prepared posers in this regard, and we will just take up one by one. I think first we should have opening remarks from all of you, sir. So I think we should start with Veti sir. So you can just, sir, in a quick view, you can just provide in 5 minutes, like a quick overview on the topic, and then we will move forward towards the posers.
Yeah, thank you, Amit. This is one of the most contentious discussion across the country because it's one of the largest employer as far as business is concerned, but the law is quite complex insofar as real estate sector is concerned. And to a large extent, this confusion prevailed in the service tax regime. And even prior to that, in the VAT regime, there were a lot of disputes as to what would constitute a works contract. For some reason or other, this sector has never had a simple or easy system of taxation and has always had a complex mechanism. And come GST, we thought that this issue would get resolved on account of the fact that works contract was defined in such a manner that works contract was identified as a service and was relatively immovable property, and therefore we thought that the matter is settled once for all. But to our surprise, the entries in the notification did not suggest that, and it became over a period of time much more complex by two events, I would say, that had happened. One, there was a lot of bad press about GST rates. The public took it up, the media took it up. They didn't realize that the rates were actually lower than before, but then the rates became a big issue. And the hotel became an example as to how you can give a 5% GST rate without ITC. Hotel is a different scenario because you have consumers. It's a B2C transaction. And for making of food, you don't have that much of goods and services that go into it, except probably the rental for the hotel. Therefore, hotel may not be the best of examples to compare, but that was the biggest deviation that was done, whereby the philosophy of GST was lost and you had a 5% GST rate without input tax credit. The second big event that happened was a series of anti-profiteering action that took place. And the anti-profiteering authority was of the view that significant input tax credit has been availed by developers and is not being passed on to the benefit of the customers. Though I wouldn't agree with the contents of the anti-profiteering authority, because most of the orders which you have seen are comparing pre-GST regimes and post-GST regimes. But the damage was done. So as a result of which, these two events prompted the government to think that if ITC is not going to be passed on, why not deny the ITC itself, and at the same time give a very consumer-friendly rate of effective rate of 5%, which will get attractive to the customer, without taking into account the fact that in a flat which is being built or in an apartment that is being built, there is so much of cost that is involved, which involves GST. Cement is still at 28%. So the non-availability of ITC would automatically drive up the prices. So the rate of tax difference or rate of tax reduction need not tantamount to a benefit to a customer, because the price will definitely go up based on the cost increase. So unfortunately, the damage was done through a series of notification in 2019, whereby these changes had happened, which you also put across. And in that process, there were other changes which happened through the same notification, which has become the subject matter of this topic. And I would congratulate JMVD for structuring it beautifully. The questions have all been well structured, and I'm sure I'm going to enjoy the presentation as we go forward.
Yeah. Thank you very much, sir. I think now we should move to Leeladhar sir, and just we should have his opening remarks on the topic.
Hello, everybody. Immovable properties are a very different things from the goods and services. While taxing the sometimes while taking a stamp duty, government says that everything is a immovable property, whether it is a joint development agreement or purchase and sales. While taxing under income tax, they says you are liable. Previously, joint development agreements were liable at the time when we enter into possession and other things. But later on, so many cases have decided, and now it is shifted to delivery and possession at the time of completion. While taxing the GST, they say it is a services. So builders are in a lecture. They don't know what is the correct procedure to be followed, because while we purchase our own land and we get project completed and we got completion certificate, no GST is payable. While we enter into joint development agreement, there are three types of liability. Whatever we sell in joint, it is liable to be taxed, owner's portion and our portion. If we get a completion certificate, we are liable for the TDR. And an owner who is getting landowner, who is getting his share, he is also liable to be paid through the developer as under reverse charge. So it has to be decided and things has to be taken at par, and there should be a level playing field for all. So I hope that today's seminar will bring something new to the knowledge of the persons. And there are so many developers and persons who are even not well aware of the liabilities. So they may not be following it properly. They may not be paying their taxes properly without understanding the things at details and length. So it will enlighten them also to understand their liability. And under the GST Act, it is very difficult that later on position, suppose after 2 years or 3 years, when the assessment position comes and they don't pay taxes, they may be in trouble and problems. Their margin of profit is very, very few, hundreds of rupees, but they are liable for thousands of rupees. So it has to be taken well care of by the persons who are the affected persons and parties to look after the rules and regulations, and they should consult their tax consultants, and this type of seminar will help them. Thank you. Carry on, please.
Thank you very much, sir. Now I think we should quickly move to VN Dubey, sir, for his opening remarks.
Good evening. Welcome you all in this webinar. Friends, basically, as our Saab has pointed out, the real estate is the one of the largest employer and of the country, and have contributing the various organs, whether direct taxes, indirect taxes, stamp duty, employment, very wide spectrum to the country, and since beginning. But taxability was always a challenge from Gammon Denkerly judgments in Wait era, first, and then further second post-constitutional amendment, and then even in the pre-GST era of service tax, and now we are moved to the GST era. As Mr. Vaitisaran was pointing out, basically we hope this seamless taxation and the free flow with the clarity, with the clear-cut introduction of the definition under the GST Act, and all these will solve the purpose. But certainly the various issues are getting created day by day, and we are even further the number of circulars, clarifications, and amendments creating the more challenges in the years to come, basically. And coming to the basic issues, here we are going to discuss whether this transaction is really what we are trying to, the development rights are related. Is it really the goods or services per se? And again, the definition either falling under the constitution other than goods, or even the similar definition copied under the GST Act is going to take it to whether other than is everything. That is the very serious challenges, and we are all yet to get answer of these questions, basically. And further moving to that, whether the allowing somebody in the right to the property which is continued to own by the person, whether, and there is no transfer, and as such, whether there is the real transfer of title or is our enjoyment of title, and whether merely with that person purpose, how it tax going to be take the effects in the coming. I think we are having number of challenges, and very interested webinar is organized by the JMVD team, and at outset I congratulate, and let us hope to have a very fruitful and interactive. Thank you.
Thank you very much, sir. Now I think Madhav sir, you can have opening remarks, and then we can follow with your view on the first poser. We can start.
Yeah. Okay, thank you for the opportunity. And here, like me being a chartered accountant and a compliance professional, the primary problem that we are facing with this development right issue is that when we try to explain these tax provisions to any builder and developer, they tend to ask plenty of logical questions in a logical order, and then because somewhere or the other we feel that these valuations and the issues have not been very logically set out, they do create a lot of issues. And now the problem is that from what we can see is that in the industry there are almost, you can say, 50 to 60% people who have entered into small kind of JDAs or maybe big kind of joint development agreements, but they are still not paying any kind of GST, and they are not taking a registration even, because they think that we will settle all those things at the end of the project, and ultimately the transfer is becoming taxable even without receipt of money. So definitely they are going to end up in trouble in some or the other day maybe. So like when we start with this issue, we say that the first thing that the government has brought to tax is that they have divided this joint development transaction into two parts, and they say that one part that they call one part to be a construction service, they call other part to be the development right. So now development right, from what we can see from various jurisprudence that we have read until now in the previous taxation regimes, and even and there are Supreme Court and High Court judgments which say that development right is primarily an immovable property. But still the revenue went ahead and said that no, development right is a service. So can again the issue arise that can we simply tag something to be a development right, to be a service, and then call it a service? Like there is a land in an urban area, tomorrow the revenue can bring anything to tax in this manner. So this is definitely creating a trouble. So I can point out various judgments in this matter that which state that development right is an immovable property. But then when we go to the definition of supply, the intention of GST law is also to tax only goods and services. From where if we can establish in the court of law that development right is an immovable property, then a builder then in a JDA transaction, I think one part of that transaction can be freed from the tax. So I would like to invite the view of Vatisaran Saab to enlighten us on what is his view on TDR, whether it is goods, service, or an immovable property.
Thank you.
Madhav sir, like
Yeah.
just we can just starting, we can just have a quick overview of the question and then we can start over it.
Yes.
Yeah.
Okay.
Mainly
Okay.
like
And we would like to have concluding view of Vatisaran Saab,
Okay.
not the opening view.
Concurring view or concluding view, we have to see.
Yes, sir.
so
So
our first issue is whether TDR is goods, service, or immovable property. So just in a brief background, we can discuss it over like our Article 246 capital A, which was inserted under the Constitution, and which even state that with respect to goods and services tax imposed by union and state. And then we can move on to Article 366 definition under 12 and 26 capital A, and then mainly then the CGST Act definition of section 2 sub 52 and sub clause 102, that is the definition of services, and also in view of entry 18 and 49 under list 2. So this all can have a view, and we can also refer about the General Clauses Act definition section 26 of immovable property, real estate definition of development. Under Real Estate Act, we have the definition also of immovable property, and also Land Acquisition Act, Registration Act. So what all each and every immovable property definition, we have a common link is that it mentions any benefit. So how this any benefit can be constituted to be a immovable property, and we have lot of sub questions, and just we will try to conclude any view that where it approaches, how it is goods, how it is service, or it is a immovable property. So Madhav sir, you can just start on it.
yes. So starting with the very constitutional definition of goods, the constitutional definition of goods says that goods are basically all kind of movable properties, and good is anything. Just a minute. Good is technically any article or thing as per our constitution, and to service, they say that service is anything that is other than goods. So when we say that service is anything other than goods, the revenue is trying to say that TDR is not goods. It is not an article or a thing, and anything that is other than goods becomes taxable as a service, and hence TDR is taxable as a service. That is what is the stand of revenue as such. But then when we come at when we try to discuss the definition but then when we try to discuss the definition of immovable properties in the Constitution, land has been given a meaning in the Constitution in the list 2, and that says that land includes land, that is to say a right in land, and then it goes on to include various things. Land also includes an improvement in land. So in our view, what like as from the SSC's stand, we would always say that development right is also kind of an agreement to an improvement in land. So definitely definitely development right can be treated directly as land. So that is what is our view primarily on that matter. But then when we go on to say that land can be this development right thing can be various things. It can be a license also, within the meaning of the Easements Act. But like we need to inquire. That is what we need to discuss and inquire, that whether a developer and a landowner, they both can together make an agreement in such a way that it looks like a license, and then they can attach a value to it, or they have to continue with the deeming fictions of that, the deeming fictions that have been portrayed by that.
Sir, I think we should only restrict now to entry 18, 49 and 246 capital A. And in meantime, we will come to all license and lease issues.
Yes, sir.
Yeah.
So entry 18 of the Constitution clearly says, entry 18 of the state list clearly says that land, that is to say right in and over land, and land tenures, including the relation of landlord and tenant, and the collection of rents, transfer, alienation of agricultural land, land improvement, agricultural loans, and colonization. So land, we are trying to say that it is very well defined here. And then when we talk about entry 46, it says, entry 49, it says taxes on land and building are completely under the purview of state. So if they are completely under the purview of state, then why is it being parallelly taxed by center and state under the GST Act 2? So that is our primary contention, which we need to discuss. Maybe the revenue can have a different stand on it.
I think we can now move to Leeladhar, sir. So, sir, what's your view about on this entry 18 issue, entry 49 and article 246 capital A, and the definitions of goods and services under Constitution as well as under CGST Act?
Actually, the purpose of taxing it by the department, it starts after K. Raheja case, when they just bring it out in this thing as a taxability, and GST has been levied as spite of expenses, it has been levied on sales price of the properties. And they have reduced the deductions also. So the joint development agreement, which has been brought to the tax, legality has to be discussed by the panelist. I can simply say in a straightforward words and languages that what we understood from this thing is that if we are providing any kind of development services to the landowner by developing the land, they are treating that much part of the development rights taxable. In case of plotted development, they are taxing whatever we are getting in terms of either money, revenue sharing, or number of plots. So market value is taxable because it is a price which they think so is the cost of the services which you have provided to the land owner. So far as land is concerned, rights of the land cannot be deattached. Once the land has been put to use, FAR is a part of the land. So FAR cannot be said separately that it is not included in the land. So land and FAR and TDR, it cannot be separated together, because once the FAR and TDR has been exhausted, the value of land becomes zero. So saying this thing that TDR and FAR is a services is not correct view of the department. But whatever they have made the provisions, so we are following it, because the present right now, we don't have anything else just to follow the things, whatever being imposed and whatever they are asking us. So I would like to have an enlighten on this subject and point from the seniors and panelists. Thank you.
Thank you, sir. So like we had 246 capital A, and last it word says that with respect to goods and service tax imposed by the union or by such state, so I think it's mainly restricted to goods and services. So anything to tax, we should first identify it to be a goods and service. And if anything it suffers from any case of immovable property, I think it is not taxable under 246 capital, but more view we will take from our panelists. So VN Dubey sir, what's your view on this? Entry 18, 49, 246 capital A.
I think there is difference between the legal and logical. I think something may not be logical, but as far the law is concerned, as far the taxation is concerned, generally we are habituated of going to have the literal interpretation, and we are following from over the years. I want that. And coming to the specifically this question, whether the immovable property per se This TDR is the immovable property, land or immovable property that is needs to be understood. According to me, TDR is the not land per se, since it is a separate, transferable, assignable, and usable and enjoyable property. TDR of Bandra can be used at India, TDR at Andheri. So it is a basically it may be related with, I agree with Aishwari Saab, it may be originated from the particular land, but as far the development rights are concerned, it is the already distinguished assets and it is a separately being transferred and assigned. Now coming to the next question, whether it is the immovable property or not. There are the various judgments which are supporting it is the immovable property. Now coming to the question of GST, whether immovable property per se is exempted. And so this is the my question issues basically as far the constitution and GST is concerned. Then coming to the judgment of Honorable Supreme Court in the case Kiran Jain, which they are talking, they have gone ki anything is the widest import and is equivalent to everything. It is 6 judges bench judgment. How it is going to make the impact in this interpretation, I think Maiti Saran Saab would be the best person to guide us. But I'm very scared of this judgment of 6 judges bench. The word anything is of the having the widest import and is equivalent to everything. This is the and again coming to the it is as far TDR is concerned, it is a benefit arising out of land. It may be immovable property or may not be. That is the may be subject matter of interpretation. But whether it is really out of the GST ambit, that needs to be examined before. And again, the coming to the point, even the prior era, prior to GST era, even service tax era, we had this matter is still pending in the Retailers Association with the Honorable Supreme Court. And a number of years has been passed and already industry started properly collecting and paying. Even the whether it was the pre-2010 and retrospective is concerned, the high courts are having their view, but all the matters are clubbed and pending before the high court, and industry has moved for collecting and doing that. Whether this will again coming to the constitutional entry, which the team has pointed out regarding 18 and 49, I have to just say that this institute talks about the powers of the state in respect of the law implementation, creation of law. As far 18, it is the relates to the land related law, which undoubtedly with the state. This I think land revenue law is still continued, and this taxing and as far the entry 49, it talks about the tax on land and building. It is a tax on land and building. Here we are talking about the tax on is our enjoyment of rights related to the land and building. Whether these two are the same or the different, I think we need the view of our respected chairman in the matter.
Sir, even I think the judgment of Home Solutions of Delhi High Court will also support this view on entries, like it's a immovable property or service.
Yes, I think with this, I'm just forwarding to our chairman to have his view on the matter.
Yes.
Thank you, and it has been quite enlightening as to different perspective, and I can understand Mr. Dubey's perspective now that he is wearing a different hat. So he is guarded and careful in saying what he has to say. I fully appreciate. As a good friend of his, I can understand his position. I've heard him before also. So the difference is this. Can we say that just because the definition says anything other than goods, everything in the sky will have to be roped into the ambit of services? If that is the question, that is the answer, then GST is the end of everything. There's nothing else we can talk about. But if you look back in terms of how the 101st Constitutional Amendment came through, and 101st Constitutional Amendment has to be seen as a package, because in one stroke, multiple provisions of the Constitution was amended. right from each of the entries in the union list and the state list, as well as the powers between the union and the state, as well as what happens if one law prevails over the other. All aspects were touched. It was a massive, comprehensive amendment to the constitution to reflect the implementation of GST. So if that is viewed in that perspective, you look at what are the amendments to the state list. All the parties, including the special committee that went into it, if you look at the report of the Lok Sabha Rajya Sabha committee that was created to look into the 115th constitutional bill and the debate that they went on in various aspects, you get a lot of insights as to what went on. And finally, when the amendment came through as the 101 amendment, if you look at state list, there have been specific entries which have been deleted. You look at entertainment tax, that entry has been deleted. You look at entry tax, that entry has been deleted. Of course, entertainment tax modified to the extent of municipalities. Advertisement tax has been deleted as far as state is concerned. So there are specific entries in the state list which were culled out, identified, and deleted, whereas entry 18 and entry 49 was not touched at all. It did not even say subject to GST. There was no such amendment made to that particular entry, which probably indicates that the real estate transactions were never in the radar as far as GST is concerned. And if one were to go by the statements of our former finance minister, late finance minister Mr. Jaitley, at every stage after the GST council meetings and at public meetings after implementation of GST, he used to keep saying that we should bring real estate sector into GST. That was a statement on a regular basis. So that indicates the real estate sector was not in GST. And the fact that a joint development agreement is also a registrable instrument for stamp duty purposes and also subject to stamp duty. That stamp duty is also an exercise in powers conferred by entry 49. And therefore, the view that I would like to take or propound is that, number one, while I fully agree that anything will be a subject matter of interpretation, but there is also a possibility that anything would mean something which is a thing. So whether anything, immovable property is a thing, can also be a question that can come into play. And second is, if you look at the series of decisions, the Transfer Property Act, where fishing rights and various other rights have been considered as immovable property, even leasehold rights have been considered as immovable property. Development rights have been considered as immovable property to some extent, but though not directly on the subject. There are touching upon decisions, but not directly, except from a VAT perspective, we had some decisions in the Bombay High Court. But we had one service tax decision in the context of tribunal, in the case of DLF, where it was examined whether the developer is liable to pay, the landowner is liable to pay service tax on the development rights transferred. And there, following Anand Behera and various other decisions, the tribunal said that development rights is immovable property, and therefore it cannot be a service and cannot be subjected to service tax in the erstwhile regime. So I would put it like this: when a landowner enters into a joint development agreement and gives development rights for the developer to develop the property, it is just not multiple rights are given. He gives a right to enter, he gives a right of possession, he gives a right to develop the property, he gives a right to construct on the property. There are multiple rights which are flowing. And one cannot just say that only one right has gone and that is the development right. And therefore, even the valuation of development right is another issue by itself. And if you take an example from the way development rights are structured in terms of these transactions, probably one may have to make a distinction when a document related TDR is issued by an authority. If an authority like a municipality or a corporation or a development authority issues a certificate saying that we give you this much of development rights whereby you can develop more FSI than what is allowed by paying a certain amount of money. And that is what Mr. Dubey Saab also referred to, where I can get this right and use it elsewhere. So that is typically possible in a corporation kind of a scenario or the development authority kind of scenario. There, it can be a big debate as to what is the nature of the transaction when the document is transferred. But between a landowner and a developer, when the developer is the only developer and the landowners are the only parties involved, and the land is the only one which is subject matter of agreement between the parties, it would be difficult to say that the development rights does not have the character of immovable property. Development rights would still have the character of immovable property. Even though the definition of services says anything other than goods, it is not wide enough to encompass immovable property, would be my view. And therefore, any levy of tax on development rights by itself can be a subject matter of litigation and a good question that will come to courts.
So I think we can now move on to next point.
Just one small input we want from YP Singh Saab. Even it is immovable property, as per the lot of jurisprudence, we can treat it as a immovable property. Since the land is bundle of rights and one of right is getting transferred, we are having number of jurisprudences in tax, weight, and as well as an income tax also. But whether even being immovable property, whether it can be per se excluded. Since the goods or services definitions are given too wide, and it may not be very clear, but it is not excluded per se also under the definition, either under Constitution or the GST Act. That is my concern.
I will give an answer in a different way. If you're a senior person, you would know the old controversy in central excise when manufacture was defined in Section 2F of the Central Excise Act, where the definition of manufacture was any process incidental or ancillary to the completion of a manufactured product. So the question that arose was, I don't even know what is manufactured, and that is why I'm looking at the definition. Whereas the definition says manufacture includes any process incidental or ancillary to a manufactured product. So how do I know what is manufacture? So the definition of manufacture was inadequate and did not answer the question. Thereby, matter landed before the Supreme Court in the famous Delhi cloth mills case. And in the Delhi cloth mills case, for the first time, the Supreme Court laid down a definition of manufacture which has prevailed over the statutory definition. The Supreme Court definition of manufacture is that manufacture implies change, but every change is not manufacture. Transformation is required, and a new product should emerge with a new identity and a character, etc. So like that, I am of the view that just like how in the case of TCS, the Supreme Court said what could be the attributes of goods, where they said goods should mean marketable, goods should mean transferability, goods should be capable of storing. When the characteristics of goods were discussed in the NTPC case, National Thermal Power Corporation case, when electricity was held to be goods, I have a strong feeling that going forward, probably in a couple of years, we will have a Supreme Court decision which will probably say what is a service and what are the attributes of a service. So I have a strong feeling that we will have a judicial definition of service in times to come.
Great.
So now I think we can move on to next I think we already have a discussed glimpse of it, but then also the TDR can be treated as assignment of interest right in land per se or transfer of undivided share in the land by the landowner in the favor of developer. So Madhav sir, any quick input on this?
Yes. So assignment and so the question is that whether it can be treated as assignment or it can be treated as a transfer of undivided interest. So like there has been a plenty of jurisprudence in this matter where it has been said that it is clearly a transfer of undivided interest, because when we talk about undivided interest, the land developer has not got right to sell the land completely, like, but he has an interest in land which is stable and it is in his favor. So one can never say that it is a complete assignment, but yes, definitely an undivided interest is being transferred where you and I, means developer and landowner, are parallelly now holding that property and both are interested in it. So that is my view.
Yes, sir. Thank you very much, sir. So Leela sir, what are your views on this? So like it is an undivided share being transferred or an interest has been transferred?
Actually, when we enter into a joint development, Firstly, I would like to say that TDR and development right are two different subjects.
Correct.
Throughout the India, TDR is not tradable. In MP, there is no provision just brought to the statute that we can sell the TDR, though it is under consideration. So even though where our lands have been taken over and we have been offered TDR or additional FAR, it cannot be, it can only be consumed in the same piece of land. It cannot be sold, it cannot be used anywhere else, like in Maharashtra and other cities. So the joint development is concerned, it is not only, it is a defer payment, you can say. As we are entering into an agreement, we are paying stamp duty for entering into a joint development agreement. Stamp duty is being charged on the market value of the land, keeping in mind and our share in account, and they are charging whole duty on the said land. So it is a transfer of particular, creating a right of ourselves in the land. So after entering into a joint development, a registered deed has been executed and the landowner cannot sell the land to elsewhere, or he cannot use it for other than the purpose for which it has been entered into. So far as joint development is concerned, land rights are always attached with the land. And once the rights have been exhausted and used, like FAR, suppose 1.5 FAR is there in any land and he is parting with us 50-50%, then 1.5 FAR we have consumed and we are constructing a building and there remains nothing in the land. So he cannot sell land later on. So whatever is the residue of the land, it has been used and utilized. So whatever he is parting with us is a land per se. It cannot be said only a service. It is only that we are making him payment. In spite of making him down payment, we are giving him constructed material. So government is charging GST on our all purchases. Then they are asking us that if it is your own land, after completion, there will be no GST. But if it is a joint development, after joint sale, if there remains any stock, it is taxable in the hands of developer as a TDR. And in the hands of the landowner, we have to charge reverse charge and pay the taxes. So there is a differentiation. While taxing, they says that no, it is not immobile property. It is a services. But while registering authority, they says no, this is immobile property. You have to pay stamp duty on it. So it has to be defined. 100% joint development is parting right with the landowner, and it is being transferred to the developer. He is taking rights in the land, and there will be a capital investment like thing which is mentioned in the JD agreement, that he is investing land and we are making all other expenses for constructing or for executing the projects. So it is a second of both the people for the mutual benefit. Little part maybe of the services, but that should have been taxed not on the basis of sale price. It should be on the basis of input price. This is what our view is there. Please carry on.
Thank you very much, sir. Thank you. Coming to VN Dubey, sir. Also, sir, please shed some light on recent DLF judgment of 2019 or CSTAT judgment from CSTAT Chandigarh we have.
Just I think as for the judge, before going to judgment, I'm having just one small revenue make argue in this way. It is a neither transfer of land nor transfer of interest in land also. It's just I'm allowing the ease and enjoyment of certain rights in the land, allowing you the construction, and I continue to own the title. And title is continuing with me. I am the owner. As Mr. Maheshwari Sahab has pointed out, maybe even in the leasing and rent transaction also it is not free to transfer. You are having certain embargo, even the long-term leases, if you are executing with the anchors. But I continue to be the owner subject to those leases. Similarly, subject to that development PDR, a development agreement, I continue to a owner, and that joint ownership is getting transferred at the time of execution of conveyance in favor of flat owners only, in which I am signing as the owner. And as far the developer is concerned, I may treat him as confirming party or in whatsoever situation, since by way of making investment as per the JDA, he is getting certain rights and interest created in the development, having some lien and charge over the property coming under the construction. That's why with the JDA as well as the development taking place, he has to also sign. If we purely go the title transfer I would be transferring as the transfer of title of land or my ownership, sharing the joint ownership. And as for the my developer is signing his own rights and interest created on account of JDA execution in that. According to me, prima facie revenue may take contention. It is neither transfer of land nor that it is a transfer of interest in land also. It is basically allowing the certain ease and enjoyment. That's why I think the proper definition of services, which we are expecting under guidance of some veteran like YT Sansab in coming years, that may throw a better idea in the line of landmark judgment of excise, what is recently pointed out. Yes, sir. Now over to you.
Sir, interesting question and new perspective which you have given. I will just juxtapose two laws in this context. One is income tax. In an income tax scenario, when a landowner enters into a joint development agreement with a developer and hands over possession of the land for development and also hands over power of attorney to execute everything, questions arose whether there is a transfer and therefore capital gains in the hands of the landowner. And one of the arguments put forth by the landowner was, I'm only giving him permission, I'm only giving him license to enter the property, I have not even transferred the land, there's no conveyance, etc. But over a period of time, a lot of jurisprudence evolved on this subject. And the jurisprudence went on to say that, can you not say that there is a 53A transaction under the Transfer of Property Act when you have given possession of the immovable property and also consideration is moved in that sense, and hence, therefore, there is a transfer for the purpose of capital gains. Now, this created untold pain in the hands of the owner because he would hand over the possession, let us say in January 2021, give the power of attorney to the developer. The property would get developed in 2024 and the owners would get those properties in 2024. Only when the owners would sell those property in the market, they will get actual cash in hand. And how do they pay capital gains in 2021 when their cash capability comes only 3-4 years later? So a lot of representations were made, and therefore the Income Tax Act was amended 2 years ago to introduce a new section called as 45(5)(a). And in income tax, what they did was they postponed the capital gains date or the capital gains taxability year to the year in which the developer obtains the completion certificate. Somehow this completion certificate seems to echo itself everywhere in every tax law. So the completion certificate, and in some states, there is no concept of a completion certificate. In Gujarat, Ahmedabad, there is no concept of a completion certificate at all. So in some states, there are only occupancy certificates, but somehow you have this word completion certificate. And the income tax law also now says that if the completion certificate is issued in a particular year, that is the year in which the capital gains tax can arise. So it is only a postponement of the capital gains liability, but the fact that it is a transfer is well recognized. If you have lost control over the land completely, you have lost possession over the land over the transaction. Now coming to your factual scenario, where the owner continues to execute the sale deed. Now, we have to be very clear here. Real estate documentation is very different state-wise, transaction-wise. In certain joint development agreements, you will find that the landowner also finds his name as a owner and the developer also finds his name as a developer. In some cases, developer is identified as a confirming party. In some cases, there is no landowner at all. The developer only executes the document in the power of attorney given by the landowner. And just to give more clarity, Mr. Leeladhar was saying how the joint development agreement is registered in Madhya Pradesh and stamp duty is paid. In Tamil Nadu, JDA is not even registered. So the joint development agreement is not required to be registered. And therefore, in fact, there is a proposal to bring JDA into stamp duty. The government is still thinking on those lines. Andhra Pradesh has got an entry for JDA in a different form. So each state has got its own variations of treating the joint development agreement. Parties have their own methodology for executing the joint development agreement. But I would hesitate to say that there is no transfer. If significant rights are moved from the owner and the owner has lost his ability to alienate some of those rights in those lands by giving it to the developer, then to that extent, there is definitely a transfer. Income tax would definitely come in. And therefore, because it is a transfer of immovable property, we may have probably take a shelter under immovable property. Now, coming to the second law that comes into play, here I'm giving a new perspective. The perspective is, Mr. Leela touched upon it. From a commercial perspective, he brought it out brilliantly. I'll just give a legal color to it. What he's saying is, yes, I'm a developer. I have constructed for the owner. Maybe there is some element of service in it. But how can you say that the owner has also given a service to me in the form of development rights? And why are you charging me, asking me to pay GST under reverse charge mechanism? So I would give some kind of legal shape to it by referring to a consumer protection case. Now, how far consumer protection case would be relevant in tax laws is another debate. But the consumer protection case is a very interesting case where in the case of Fakir Chand Gulati, the fact was that, let me put some names here so that it makes it easy. Let us say Mr. Amit Dubey is the landowner and Mr. Madhav is the developer. So both Amit and Madhav enter into a joint development agreement. And then Madhav, being the developer, tells Amit that I will build 40 apartments in this land. And out of the 40, Madhav says that he will keep about 25 and give 15 to Amit, being the landowner. So Amit is entitled to 15 apartments and Madhav can sell 25 in the market. For some reason, Madhav, being very busy in active practice, does not carry out development on a very focused manner. He prefers GST practice than construction. And therefore, the project is delayed unreasonably. And at a point of time that Amit gets frustrated and decides to go to consumer court and files a case saying that you have not handed over what you have promised. Now, Madhav brings about defense saying that Amit is a landowner. He is not a consumer. Number two, he says that our agreement should be seen as a joint venture and not as a service agreement. So these two arguments came before the Supreme Court in the context of Consumer Protection Act. And Supreme Court said the landowner is very much a consumer because he has availed the services for his portion of land, or his portion of apartments to be constructed. And therefore, the landowner is identified as a consumer for the purpose of Consumer Protection Act. Second, the argument was that, no, I'm not providing any service. The Supreme Court said, no, you are providing construction service for those 15 apartments. Therefore, you are providing a service. Then Amit argued, then developer argued, saying that maybe I'm providing a service, but there is no consideration flowing from the consumer. Since there is no consideration flowing from the consumer, you cannot say that Consumer Protection Act is applicable. There, the Supreme Court gave a brilliant paragraph where they said, the land that is given up by the owner is the consideration for the apartments constructed by the developer. So what was a full ownership of land became a diluted ownership of land. And what was ownership was given up was identified as the consideration. Now, if I draw a parallel from all this, if the land or the development rights which are identified as the land are treated as consideration for the construction to be done, then maybe you have a GST case to put on the developer to say, please pay GST on what you construct for the owner. But what is a consideration for the construction should not be a supply by itself. So development rights or land that goes through can be seen as a consideration for the construction done by the developer, but should not be seen as another supply made by the owner to the developer. If that position is well established, then we have a good case to argue.
And sir, just an addition, if JDA fails and developer wants to, like for example, JDA fails means that builder is not able to get the possession of the building. Landowner says that it's my property and I won't give you the possession.
Right.
Any such thing arises. So in court, he will go mainly for specific performance.
Correct.
Yeah. But he won't be going for any injunction suit and claiming that this much flats belongs to me and I should get the possession.
True.
So I think
You're
that
right.
can also be seen, like what difference it makes.
What right to enforce is also important.
Yeah. So I think we can move on to next. I think already we have discussed this issue also, like it is a bundle of rights or not. So I think we can move on to next directly point that whether it can be treated as a Section 5 transfer, which says that under Transfer Property Act, that it's a transfer of owner to owner himself and the developer.
I think we have touched upon to some extent. Given the paucity of time, we should move on.
Yes, sir. This is another question that what does developer signature on the sale deed imply? Being an interested party or a joint seller or as developer in both cases of area sharing or revenue sharing or area distribution. It's a revenue sharing. So I think Madhav sir, any inputs on this?
Yes, sir. No great input as such, but yes, it is varying from state to state. Like in some state, it would imply as just as a confirming party, and in some other state it may imply as a part of developer, because in some states there are two separate agreements. Two separate agreements are signed. A transfer of land is executed, undivided share in land is executed in favor of the customer, and a constructed property is executed in favor of the customer. So in that case, it might be treated as maybe there are two different parties selling their different products. So that is how it is.
And with this, another question we can take that registration of JD at different stages, like at the time of handing of position or earlier before the handing of position can make any difference. Madhav sir on this also.
Like at the time of handing over possession and at the time of handing over can make a difference. Like in basically registration of an agreement is a matter of legal protection, and I think that it doesn't matter a lot. Like I would request views from the seniors.
Okay.
I would just like to mention something that in Madhya Pradesh, without entering into a JDA agreement registered, you cannot put forth further. Even your maps will not be entertained because your license will only be entitled when you are having a registered joint development agreement. And the registration charges on the development agreement is prima facie equivalent to the percentage which you are enjoying. So that means suppose a 10 crore worth of land is there and I am having 50% share. So there are charges on the JDA agreement will be on 50% share, 5% liability of stamp duty is there. So they are treating it under the Madhya Pradesh Stamp Duty Act as a transfer of the rights in the land. Though there is no amount has been taken shape in exchange of this, and we have to give constructed portion to them. So as the matter has been discussed, once the construction has taken place, it cannot be separated. You cannot say that land is there and the constructed portion is separate. Though some states are having transfer of the proportionate TDR or proportionate percentage in the share ratio of the land in favor of the purchaser. But in MP, there will be only one transfer that will be of the flat. So it cannot be separated. Even in sale deed also, I would like to mention that this is the land price and this is the sale price of the apartment. They said, no, we will accept only one thing, that this is the price of the apartment. And there are guideline value also of apartment. It cannot be once constructed, it cannot be separated. So this hardly makes any difference because we have to sign the document once our registered development agreement is there. So on each and every sale transaction, whether it is of owner's portion or developer's portion, we have to sign on the document as developer, and we have to mention the sale proceed is going to owner or it is going to the developer. This is the normal procedure in terms of material which has been divided. And in terms of joint sale, it is coming, everything is coming in a escrow account and we are dividing the sale proceeding on the basis of percentage.
Yes, sir. Sir.
Yes.
Now we can have your view on these two issues, like all the developer signature on the sale deed and the issue of this registration of JDA at the time of possession or before the possession.
I think signature of developer and the title owner we have already dealt with earlier. I think making the signature is just not going to make difference whether it's signing as the sharing the title or whether it's signing as the confirming party. That is the another way it's taking it. But certainly, as far these points of Mr. Madhav is concerned, having the two separate agreement, even it is permitted with the certain states, how it is going to be the practically having the wider relevance, since it is a transfer of flat in which the undivided share of land along with the construction is getting transferred. But whether separate is possible at all. And then as far the Maheshwari Saab view is concerned in that way, okay, so certainly even after the payment of the conveyance equivalent to conveyance stamp duty, whether really the property is aligned or transferred or with the developer, so there may be the termination of the JDA also. There may be nothing to happen after that also. And whether it is going to be treated as par with the agreement to sell with the specific performance and all these are something more or less that is needs to be examined. I think over to IT Sansab.
No, I have nothing further to add to what Dubey said. The timing does not make a difference. It goes by what the law requires. And if registration is mandated at that early stage, it is mandated at the early stage. There's no change. People used to have power of attorney at different points of time to probably get over that Chaturbuji judgment in the Bombay High Court when it happened in income tax. So they used to execute power of attorney for permissions and subsequently a power of attorney for sale of undivided share of land. But those days are all over.
Okay. I think this is the last question on this page, that TDR can be considered as capital contribution of landowner in a project. Madhav sir, your Q.
Yes, I think in all the revenue sharing agreements that are happening, maybe in the city of Bombay and everywhere, TDR is being considered as the capital contribution of the landowner. But in what happens in a revenue sharing agreement, the revenues are very clearly defined and actual cash flows to the developer and the landowner on the same property. So and generally they're registered partnership firms, and that is how they execute revenue sharing JDAs. So in that case, it has to be it has always to be considered as a capital contribution. But in case of area sharing agreement, because there is no capital visible directly, the revenue may not agree to the fact that it is a capital. That is what is.
Thank you very much, sir.
My point.
Maheshwari sir, like what's your view on this? It's a capital contribution of landowner. Maheshwari sir. Up to the.
I think I can.
Yes, yes, sir.
Give my inputs in the meantime. Maheshwari Saab is coming.
Yes, yes.
Basically, in my humble view, whether the revenue sharing or area sharing can really makes any difference. This is one question from my side. Whether it is revenue sharing or revenue high, and again, even it is going to, we can treat it as the JV or AOP or whatever we can form. It is a capital contribution from the owner of the land, and as well as some financial infusion by the builder in their separate. But as far as GST is concerned, it is going to fall under the separate person category, apart from the landowner and apart from the developer. And being the separate person, how we will be able to come out of the GST implications that may be required to be examined in that way. Mr. Maheshwari, if he is connected, otherwise we can move with the Vaiti Sansab.
I think we can move to Vaiti Sansab. Oh, yes, sir, he is correct.
Let's come back.
Yes. We need your quick view whether the TDR is the capital contribution to joint venture. Can we interpret this?
Definitely, TDR is a capital contribution to the joint venture. It is mentioned in the agreement itself that land he is bringing as capital contribution, and we will be spending everything else than the land in constructing and executing the projects. It is even mentioned in the agreement itself that his contribution is as a capital contribution. He will not be investing anything further. But one thing is, I would just like to mention that what is the transaction is happening in joint development. I am just entering into a development because there is a huge capital investment required nowadays. So this is a very popular practice that we are entering into a joint development with the landowners who are having land parcels. So they are asking us that you construct the things, you execute the thing, and you invest, and I am providing you land. So whatever I am giving him constructed portion, it is in exchange of the particular portion of the land which I will be utilizing. Whether you say it is a development right, whether you say it is a TDR. But that much portion of the land on which we will be constructing our portion and we will be selling, so it belongs to us. So whatever I am providing, even if services is concerned, I am constructing the things, certain things for him. That is the only portion which is construction services. The entire project cannot be said even after completion that he is providing us TDR. He is in exchange of sale of development right will be getting constructed portion. So TDR cannot be taxed again. There cannot be separate things. And the 40% or 50% share which is retained by him is continue to be belonging to him. So whatever he is parting with us, I'm in exchange of payment, in spite of payment, I am giving him constructed portion. So this cannot be said again to be taxed again and again. Let the time my project is completed, I am handing him over. That's okay, fine. But they say, no, now whatever is left with you, you have to pay tax on it as a TDR tax. So this is taxation which is not acceptable. And it gives additional burden as compared to the ownership project. If I am having my own land and having completion certificate, I am not liable to pay such type of tax. But under the joint development agreement, this type of liability is there. That means 100% flat or 100% unit has to be paid taxes. This is the intention of the government by bringing this provision.
Yeah.
Over to Vaitisan sir.
I would go with Madhav when he says that if you get into a formal arrangement like a partnership firm or an LLP, and you ensure that the land is contributed as capital and the money is put in by the developer, and the transaction is clearly a revenue sharing arrangement whereby a certain percentage of the collections is handed over. So we are now departing from area sharing to money sharing. So when you go into a revenue sharing model, the developer would continue to sell all the apartments to the customers, collect all proceeds, and it will go straight to a bank account. And from that bank account, there'll be a swipe instruction where a certain percentage of money will automatically get transferred to the owner. So from a simplistic perspective, the moment a revenue sharing is implemented, the question would be, is there any service at all provided by the developer to the owner? In the area sharing, we had the problem of somebody getting something constructed. But in a revenue sharing, there is nothing that is constructed for the owner. The owner gets only money. All the apartments are constructed and sold by the developer to various customers. Therefore, revenue sharing is probably a much easier model, but unfortunately, it's not a very popular model. Most area sharing is the popular model because of the fact that revenue sharing would take time, because only when sales happen, money will come. And therefore, landowners are hesitant to get into a revenue sharing model. Though a revenue sharing model is much more tax efficient than an area sharing model. Of course, you'll have to be careful of not getting into the pitfalls of an AOP. You have to ensure that the guidelines of Linde judgment of Supreme Court is followed, as well as income tax principles on AOP is followed, to ensure that you don't fall into the trap of an AOP. Otherwise, it's a good model for implementation.
Thank you very much, sir. I think we should now move faster. I think we already approached 5:45.
Yes, please.
But the thing is that already a lot of issues are there, and endless debate can happen on it, and endless discussions. Madhav sir, I want that we can just club these 2-3 questions which seems for example, you can have your view on this. Any benefit is there if JDA can be considered as lease agreement under section 105 TPA, or can be considered as license or leave and license leave an agreement under section 52 Easement Act, and differentiating that to enjoy land or occupy land. Two concepts we have. And also question is the last one which we are seeing, that whether JDA can be considered as an agency contract where builder is undertaking all the development activities as an agent on behalf of the landowner. And also coupled with section 202 of Indian Contract Act, which says that any agency can't be terminated unless if there is any interest is there of the agent, and that interest and there we should require an express agreement for termination as per section 202. So Sir, Madhav sir, your
Yes, sir.
quick view on these 3 points.
Yes, sir. So starting with lease, I think a lease is a transfer of property to is a transfer of a right to enjoy a property as per section 105. So right to enjoy is a very wider right, I believe, because in a joint development agreement, the developer cannot decide to do anything he wishes on that property. He has to be very limited in the bounds of the agreement. So I think even if we consider, no one else would consider that it is a lease. But then again, coming to a license, yes, in license it can be said that yes, like the department is trying to attach a value to a development right. So like what happens that when we take a license, it can happen that a developer can give landowner can give a license of 2 years for development to a developer, and maybe then they can attach a specific value to development right. I don't know if this will work for the taxation regime, or they will continue with their valuation, because whatever is the visible value, they must agree, because the transaction is, if a transaction is between two unrelated persons, that value has to be accepted as per section 15. And then comes the third part, which is whether it is an agency. So that all would end up on depending on the kind of agreement that has been entered into. If the agreement says that okay, it is a kind of agency where the landowner has appointed developer as an agent to develop and then sell, then maybe it can work as an agency contract. That is what is
Yeah,
my
thank
view.
you very much, sir. So up to Maheshwari sir. Sir, is there any benefits of such agreements?
I don't think so.
Any drafting, sir?
No, sir, that doesn't make anything, because it's a plain and simple as things as, because it is not only the property of the landowner. We are making investment of crores of or lakhs of rupees in the development of the property. So we want to safeguard our interest also. So joint development agreement is a proper thing. Only thing, it has to be minutely considered while executing and drafting the agreements. And all these problems which has been discussed here and the forthcoming problems has to be kept in mind. So legal liabilities cannot be avoided, but yes, it is to be brought to the knowledge of the government and department. They are taxing multiple times and multiple process of the taxation is there. That should have been avoided. Present tax and law, whatever it says, we have to follow it. So it hardly makes any difference in the lease rights or joint agency and all these things. This is not acceptable to the peoples in a normal procedure, sir. And I think so now we are running short of time also. We should move to the plotted development also, sir.
Yes, yes, sir. So
Quickly with the two Vice Saab, I think prima
Yes, sir.
facie we are okay कि leasing or service, it is not the substance.
Yes,
But,
it doesn't serve any purpose. It doesn't
Yes, yes,
address
yes.
the developer's rights.
Yes, please.
Okay, thank you very much. Now I think we can move on to next. That is topic is long-term lease of land, like 99 years and so. So what is whether acquisition of long-term lease is a sale of immovable property, and with reference to notification 5 of 19 dated 29th March 2019. So Madhav sir, what's your views on it? Just
Yes.
give a quick view. Yes.
Sir, in a recent case law of GST era only, Builders Association of Navi Mumbai versus Union of India 2018 judgment, the court has, Bombay High Court has opined that it is that even though it might be a tax, like it has taxed immovable property, long-term lease of immovable property is under GST. That is what the court has opined. So like I think for now we will have to agree to this judgment, and that is what is my view. But I think seniors can guide further
Yes,
that
yes.
whether this judgment will stand test of time.
Thank you very much, sir. Maheshwari sir, what's your view on this long-term lease?
I think so. Chairman sir will give his opinion on this.
Just before moving to Vice Saab, I'm having just quick view. As far the long-term leases, it is the way of prima facie, is my independent professional view. It is the transfer of one of the mode of transfer of property. But at this time, we are having the Bombay High Court judgment, and how we should take it forward professionally and as industry. I think Vice Saab will be able to throw some light on this.
Yes, sir. Bombay High Court is one in the discussion, and it is now pending in Supreme Court. But as again, I would bring some kind of reference from direct tax. There is also a Madras High Court judgment in the case of Foxconn, where one of the questions that was raised was whether the lump sum which I pay for a 9-10 year lease of a huge parcel of land, whether the lump sum would qualify as rent for immovable property or lease of immovable property for the purpose of 194I of the Income Tax Act. And there the Madras High Court said that it is not leasing of immovable property, it is not renting of property, it is a transfer. And therefore 194I would not apply. Therefore, there will be interesting views. Matter has to be resolved only with the Supreme Court. There have been passed a lot of judgments, Panipat, so various old judgments are there. There's a distinction between the rent for using the property and the lump sum amount for getting the right to get that property. So that kind of distinction is there in a number of old judgments. Those principles will come into play, and we'll have to see how the Supreme Court looks at this particular issue.
Just one small question, Vaidhi Sanjay. As far as the leasing is concerned, we are having the leasing a mode of tenancy also. Basically, that we are leasing the premises and getting the rent. Whether it is executed as lease deed, or executed as the rent agreement, or executed as the leave and license. This is just allowing somebody. But as far the government land is concerned, whether the DDA or whether IDA we are having, the long-term leases are being awarded. It is just conveyance is taking place over the property and having the specific development and owning the as good as. And how these two leases can be differentiated from taxation point of view while dealing with GST impact.
Yes, that's a valid point in the sense that when the difference is like this, when a huge tract of land is given by the government for development purposes as industrial plots and industrial use for 99 years, the typical understanding is that it is almost treated as a conveyance in all aspects, including the value, including the market rate that they fix for the particular value of the for the lease, etc. It is not calculated as your monthly rental is 5,000 rupees, so it is as a yearly rental is 60,000 rupees. Therefore, 9 years you pay so much. That is not how it is calculated. The value of the land is how it is calculated, and that is probably the reason why that they brought out the distinction between a mere rental and an acquisition of a certain set of rights. And in fact, the GST has given certain exemptions in the context of government-related projects and state bodies like SITCO or a state corporation which gives industrial plots of land or for certain conditions, and that gives rise to some kind of interpretation that only those projects are exempted, all other long-term leases are taxable. I would beg to differ to say that mere exemption entry does not mean that some other things are taxable, only those is exempt. We'll keep that for another day. We'll move on for want of time.
Thank you very much, sir. I think now we can move on to sale of developed plots. So whether a sale of developed plots is a goods or service, and coupled with the question that it can be considered as supply of service with sale of land, making it as a taxable as a mixed supply, and whether sale of developed land would have been taxable had it not been excluded in Schedule 3.
Just one small clarification, Amit. I think we are not talking about the JDA of development of developed plot. Rather, it is the sale of developed plot by the landowner itself.
Yes.
Yes.
So
yes.
in this case, sir, in this case, what is happening is that the revenue, what we can see from JDA is that the revenue has become very, very aggressive in their stand. So sale of developed plot definitely implies some amount of service. And tomorrow, like I think if the revenue brings another notification and tries to find a value of service in developed plot, then it can be a trouble for people. As such, for now, the normal compliance stand is that developed plot is also not liable to GST. But again, a BSNL judgment was there of 2006, wherein the Supreme Court has opined that you cannot go on finding value of service in everything. Like when something is visible, clearly visible as to what it is, you cannot attach value to something else and then find value of that thing and then bring that to tax. So using those judgments, using those jurisprudence, as of now, we believe that developed plot is a developed plot. It is neither goods or service. But again, there are some advanced rulings where in case of JDA or developed plots, they are charging it as service. So I think Leela sir can further opine on this.
plot cannot be said to be covered under the GST so far as the landowner is concerned if he continues to develop the own colony. However, the JDA is there, that part is having little bit of things which is to be considered because so many advanced rulings it has been given that the portion which the developer is getting will become taxable and he will be getting set off of the services which he has obtained or goods which he has purchased. So there are certain advanced ruling which says that if there is a joint development agreement for developing a colony, the portion which developer will get, it will become taxable. Suppose that there is a 75-25% ownership of the developed plot is there and 1 lakh square feet is being developed and 25,000 is being received by the developer. So market value, suppose 1,000 square feet, so that 2.50 crore, it will become taxable in the hands of the developer and whatever amount purchased he has just spent as a GST, which will be given set off. This is what the advanced ruling says. It has to be think in these terms that whatever our constitution says, that land is not taxable. Nowadays, department is keep on going taxable each and everything which belongs to land, whether in part or in parcel, or by just screwing it. This development right is different, TDR is different. This everything will become taxable. Then don't charge the stamp duty. Make it a goods. Why you are charging stamp duty? In stamp duty, you sell different thing. Then make it free. It becomes goods. Everything is taxable and sellable as goods. Some property rights are there. If the rights are there and it is to be transferred, then it is to be seen in that context. So this definitely advanced ruling says that it is chargeable and taxable.
Thank you very much, sir. Up to Dubey, sir. Yes.
Logically, I'm with Maheshwari Saab, basically being the land, whether it is developed or not developed, should be exempted from GST. But one prima facie question may be coming from revenue point of view. In a plot of 10,000 square meters, you are executing the sell deed of 7,000 square meters to seven people, and 3,000 square meters, you are allowing the ease and enjoyment over the rights over that land, number one, either by way of developing the road or other facilities. And further, you are creating certain facilities like drainage, pipeline, water pipeline, and electricity in respect of the plots. They are not buying their isolated plot, and they are, along with the isolated plot registry, they are getting certain rights over and above that. Where here is the question, whether that over and above tantamounts to the supply or not. That I think we are before Vaiti Saran Saab.
It's a very good question. Firstly, let me pick up from what Madhav said, that when I sell a developed land, now I am the owner of the land. I'm developing it because only if I develop it, I can sell effectively. Otherwise, it will be forest or barren land. Nobody's going to buy it. I have to make it attractive, make it into plots, give the gift to the municipality, ensure lights are put, drainage is put. Otherwise, it is not even marketable as a plot of land. Therefore, what all I spend to make the land attractive to sell is only to sell the land and nothing more and nothing less. So let us examine a situation where I'm manufacturing a car. If I sell the car in the metal format without painting it, nobody's going to buy it. So I have to paint the car. I have to ensure that all the windows are beautifully done, etc. And if some cushion seats are required, I have to put cushion seats. If music system is required, I have to put music system. So whatever I do at the factory, which is fitted into the car, will form part of the value of the car. One cannot subsequently discern and say, no, you have provided a painting service on the car. The painting service should be separately taxed, even though you sell the car. So that is how I would give it as an example and say, whatever is put for developing a plot of land is only for the land and for the benefit of the land and should be seen as a sale of land as far as the first transaction is concerned. When it comes to joint development, it again depends upon how it is done. I repeat here, the different states have different philosophy in how it is done. In some cases, what happens, the owner gives the power of attorney to the developer. And then the developer sells all the plot of land and then gives some share of money to the owner. And the owner offers this as capital gain in his hands. And there are decisions which recognizes that there is a transfer of immovable property when all rights have been conferred, and that should be taxed as capital gains in the hands of the owner. So the question would be, the conveyance is executed by the developer to the customer. Plots are sold by the developer to the customer, but money is given to the owner. Now, going back to what is called as these advance rulings, which is haunting everybody, with due respect, I think professionals should take a backseat from applying for advance rulings. I won't blame the revenue. I have not come across revenue taking a stand that plots are taxable. I have not come across revenue issuing show cause notice that developed plots are taxable. It is our fellows who go and ask. They go and ask and say, sir, I'm doing this, I'm putting this light, is it taxable? Oh, it is taxable. You come and ask and say it is. Then it becomes a national news and then it gets reported, then everybody gets scared. So I think somewhere probably Mr. Maheshwari could pass on this message that at least the real estate community could probably refrain from asking all these questions at an early stage. Because I don't think the revenue also is so keen to tax all these things. The revenue is not that behind all these transactions and they have left it as such. Whereas our fellows go and ask, and when they go and ask, they say, okay, it is tax.
Going extreme caution is too dangerous.
Yes.
Yes, please.
So I think we have left with two major topics, and we will just will be clubbing all the issues in that topics. First one is the regarding valuation, that is for supply by owner to builder, and another valuation issue when for the supply from builder to owner, that is of construction services. And then we will going to the ITC disallowance. So firstly, with the valuation of TDR supply by owner to builder, we have the first question: if the transfer of TDR is considered to be supply of services, what shall be the value of such development rights? And does the valuation mechanism provided in notification 4 of 19 dated 29th March 2019 appears to be appropriate with reference to section 15 CGST, read with CGST rules of 27 to 31. And then we will I want your points on the valuation of construction services supplied by builder to owner in regard to what shall be the value of construction services provided by the developer to a landowner under a JDA, whether the mechanism of valuation of construction service as provided under instruction 3 of 19 is appropriate. Then this is the very important issue: only 1/3 of total realization in a flat unit is allowed towards the value of land, whether it is appropriate to fix such limit or deem valuation, and whether tax is not levied on the transfer of land in case value of land exceeds 1/3 of total realization. And then whether the term construction service is wider than works contract, and how to deal with the issue of composite supply and mixed supply, if any. So this is the bundle of all issues under valuation services, valuation of the service. So up to Madhav sir, you're quickly over it, and then we can take up all of them.
Yes, sir. So when we come to valuation, there are two parts. Like the revenue has separated this transaction into two parts. One, they call it construction service. Another, they call it development right. Now, if a proper valuation mechanism does not exist, it as per earlier jurisprudence of Govind Saran Ganga Saran case, the levy fails if a valuation mechanism does not exist. But now in case of construction service, again they say that that the share that the landowner has received from the builder, that shall be taxed in the hands of builder as a construction service. Now again, and then they go on to levy a value of that construction service. The value of that construction service is the expected sale value of the flat. So now the sale value of the flat, it contains a lot of things. It contains the construction cost, it contains interest, it contains land, it contains advertisement, it contains profits. So GST is a value added tax. This very fact has been disregarded, and only to exclude land they have given a reduction of 1/3 value. Now 1/3 value is again a deeming fiction. A deeming fiction that in a city like Bombay, sometimes the value may be as much as 85% of the project cost. And when we come to construction service is a very, very visible service. Like in a city like Indore, 1,400-1,500 rupees a square feet is a very good quality construction. So why are we then going ahead and deeming a value? So that definitely is a case. Further, they have called this as a construction service, while the courts earlier in the case of Sumer Corporation, Bombay High Court, has said that this construction service that is being given by the developer to the landowner is nothing but a works contract, and what the developer is receiving as a development right is nothing but the consideration. So still again and again they have brought this new concept. Like earlier this works contract concept was extremely litigated, and now they have brought this concept of construction service. Perhaps they have brought this concept only to bring a deeming fiction in value and bring it to tax. Because if they would have continued to call it a works contract, then valuation would have become a very serious question. Even now valuation is a very serious question, because section 15 clearly says that open market value shall be considered at first if the buyer and seller are not related. But here they say that no, okay, the nearest point in time, the value of the flat at the time of when the construction is complete and sold to the and about to be sold or sold to the buyers, that time the whole value of the flat shall be considered as the value of construction service, and 1/3 deduction will be granted on account of value of land. So this is definitely something in violation of section 15 and the rules 27 to 31. Even in the rules 27 to 31, they have been talking about valuation in terms of money, partly in money. But here the here the consideration is wholly not in money. So if we go absolutely by the word of law, again when we see these notifications would not stand the rules. And further, section 15 clearly says that valuation has to be prescribed. But here they have again and again directly notified a valuation. So that is definitely a violation of a rule of law that is being followed in our country. So that I think is an issue. Another issue when we come to development right, that again is an issue that they have taken the share of the builder, what the builder receives as the number of flats which the builder receives, they call that as the value of development right, while the value of development right is nothing but a value of land. So can the revenue bring such deeming fictions into play by simply notifying things? That is a question which should definitely be tested in the court of laws. But again, there is one satire which Mr. Y.V. Reddy wrote in his book, that past is also uncertain in India, that future is always uncertain, but in our country past is also uncertain. Like if at all the courts give a positive judgment saying that okay, all this was not correct, but the revenue can go ahead and change the law retrospectively, and that would again become a trouble to all the assessees. So that is what is our point in this, that construction service and development right, first thing, they are two things that have been separated. Actually they are one thing. And then again, even if they are separated, the kind of mechanism through which they have brought these two tax is not as per rule of law. Over to Leeladhar sir.
Thank you very much, sir. Up to Maheshwari sir, your view on this valuation.
Actually, one thing is very sure about it. Prior to the GST provision, service tax was there. In service tax, 1/3 of the value of the sale was taxable. They were treating it that it is a portion which is consisting of labor, and remaining 2/3 that was for the material as well as land was not taxable. So in the GST era, they have just reversed it. What government wants to have it, ultimately, if one has to see, we have to see right from beginning. Previously, we used to pay purchase tax only for the URD purchases. Then it comes to service tax. We started with the 3% and gone up to 12%. So now the GST is there, which is as high as 18%. Then some deductions are there. It comes to 12%, then 8%, 1 and 5% ultimately without any benefit of the set off. They have just brought it. So far as valuation is concerned, you just take, we have to understood, in Mumbai, suppose a flat costing 80,000 rupees or 1 lakh rupees per square feet, they are giving 1/3 deduction. So it is 67,000, which is taxable at the rate of 5%. Whether cost of construction can be said to be 67,000 rupees? It is impossible. So there it has to be restricted. Even in Indore, suppose a flat is being sold at 10,000 rupees per square feet and 1/3 deduction has been given. So can a cost of construction at Indore can be said to be 6,700? Even IDA or the statistical books also says 1,400, 1,300 rupees is the cost of construction. Guideline says it is 1,100 rupees or 900 rupees per square feet. So we have got guidelines throughout the India, which is called ready reckoner rates. So deduction of the ready reckoner rate should have been allowed. The price, market price of the land divided by the FAR, that should have been allowed for the past purpose of construction. Why deeming fraction is there? Because apple versus apple cannot be said to be throughout India. Where 1 lakh rupees per square feet sale price and 1,100 rupees per square sale price, you are giving 1/3 deduction. How it can be said to be correct procedure? That's why it becomes very costly, and then government says you are holding the goods and you are selling it higher price. How can we sell it? Customer has to bear 5% of the 2/3 cost, and customers are in a jeopardy. They are not in a position to afford it. So the material is being stuck up. So valuation game should have been properly mentioned, and in spite of deeming fraction, it should have been either allowed the ready reckoner rate price divided by the FAR. That should have been the correct procedure, or there should be a restriction on the cost of construction city wise. Government has got rates for the CPWD. They can restrict, they can apply the CPWD ready reckoner that this is the cost of construction city wise. So there should be a restriction of the cost of construction. There cannot be a free hand to the tax rate at 5% by taking any amount. Say, as I have given the example of 1 lakh rupees per square feet sale, they are asking to pay 5% on 67,000. 67,000, 5% if we take it, it comes to 3,300, which is more than the cost of construction. Tax is higher than the cost of construction. So this cannot be said to be logically correct. It should have been looked into, and it should have been brought to the tax in a proper manner. Either it should be on the input cost. Whatever input we are making in construction, they should charge tax on it, giving a set-off for the input cost, and remaining they can tax. So land portion is there, which can be excluded. Or they should give the deduction on the basis of ready reckoner price. That should have been the correct procedure. But whatever land of the law is, whatever law is there, it is, we have to follow it, whatever is there, and we are paying taxes accordingly, which is causing trouble to the end user and customers. Over to you, sir.
Thank you very much, sir. Now to Dubey sir, and then the overall view from Vatiswaran sir.
I think taking the issue, really the issue is challenging in spite of having CPWD rate, in spite of having guideline rate of the land area, in spite of having everything available under the different statutes, and it was readily available and being taxed, even stamp duty is being charged. Whether this deemed valuation pan-India was required and relevant, and whether it is valid, I think it is required to be certainly tested. This is a very serious challenge. And as for the Mr. Madhav's points of view, is the telling of valuation mechanism. Prima facie, I don't foresee any. I think there may be the valuation mechanism is flowing. That's why the judgments of failing back valuation mechanism to what extent will help the SSE in this case. Again, I'm having my reservations. Over to Vaitisaran Saab to have concluding remark.
Thank you. And a very interesting question and well touched upon by Mr. Leeladhar. The fact of the matter is, when you have something like a 1 lakh square foot rate, and your, as he rightly put it, the GST calculation will be much more than the cost of construction. So where does it all come to? Where did they come up with this 1/3 figure? Now, if you look at the service tax regime, as was rightly pointed out, the 40% of the value was identified as taxable services and 60% was knocked off. And the 60% was knocked off to eliminate land as well as goods, because goods could not be subject to service tax. So with that in mind, they thought that in GST, the reverse should happen. And therefore, they thought that, okay, we'll put at 67, we're being liberal in terms of what can be collected. 60 went to 67. And that is why the 1/3 deduction has come. So because materials also get taxed in GST, whereas in the earlier regime, only VAT was applicable on the materials. Now, whether 1/3 is the end of the story, while everybody would say that the statute declares it as 1/3 and therefore that is the only choice, I would beg to differ, being a professional taking up these tax matters across the country. One is, let's look at some of these provisions which are there in other legislations and how it has traveled in courts. For example, if I'm an importer, I import goods into the country. So I pay customs duty. So let us say I buy something for $100. I pay basic customs duty. Now, what the customs law says is, on that value of the goods, please add freight, please add insurance, please add loading, unloading charges. These three charges have to be added as per the customs valuation rules. And it also said, if you know the actual freight, take the actual freight. If you don't know the actual freight, take 20% of the FOB. Insurance, if you know the actual insurance, take the actual insurance. If you don't know, take 1.25% of the insurance of the FOB value. As far as loading and unloading and handling charges, the rule said 1% should be mandatorily added. And that was challenged before the Supreme Court in the case of Wipro. And the matter came before the Supreme Court read down that provision by saying that even though the rule says 1% must be added, it is read down whereby it is up to the importer to say actuals are available, I can adopt another figure, and that figure should be added instead of the 1%. Because just like this construction, the 100,000 square feet rate versus things like that, in certain commodities, the 1% of the value will be very high, but the loading unloading charge will be hardly thousands of rupees. So the assessee could demonstrate that my loading charges is 10,000 rupees, but as was 1,000, 1% I have to add 1 crore to the value. So he was able to justify it by saying that I can take the actual value. Supreme Court accepted by reading down the provisions. So there has to be a challenge to this notification at some point of time. In Calcutta, one matter has been filed. Let's see how it goes. Even otherwise, I agree with Madhav when he says that the notification itself has got its own issues. Because notification 3/19, if you look at it, it has been issued in exercise of powers available under Section 9, Section 11, Section 15, and Section 16. Now, 3/19 is primarily a rate of tax notification. If it is the rate of tax notification under 9(1), the government is empowered to issue rate of tax, but it cannot put conditions in rate of tax. You cannot say rate subject to ABC. Conditions cannot be put in a rate of tax notification. Conditions can come in a valuation notification. And that is why they probably refer to Section 15. So I would perceive that this entire 5% without ITC should be seen as an exemption notification, whereby the general rate is 18%, but the special rate is 5% without ITC benefit, with subject to a layer of conditions set out in the right-hand portion of the notification. And being a conditional notification, is always open to somebody to examine that why not I take the full rate and take the ITC. Of course, that is up to the developer, that is up to the litigation appetite of the developer, but there is a proposition possible in terms of the interpretation. And second is, as he rightly put it, prescribed is what is the word used in Section 15(5). And 15(5) prescribed is the word prescribed is also defined in the CGST Act as prescribed by rules. And therefore, putting all these things in the notification may have to be tested in courts because they have not done in the correct format. Now, coming to the last point, as far as, of course, I still maintain that development rights per se is not taxable. Therefore, I'm not getting into the valuation of development rights. I'm going to the next part where I agree that there is a service, there is a supply of service by the developer to the owner when he constructs something for the owner. How do you tax it? Now, let me put it this way. I go to a tailor. I give him my cloth material and then ask him to stitch a shirt and give it to me. Now, when he stitches that shirt, I can at best pay him tailoring charges and little consumables or materials that he uses to convert the cloth into shirt. Now, he's got a separate ready-made garment division in the same premises where he makes his own shirts and sells in the market. Now, that ready-made shirt price is very different because that has got his marketability, his business, his brand, his over-investment, his employee cost, all those things are factored. So, can the tailor tell me, sir, I'm selling my ready-made shirt at 10,000 rupees per shirt. I will adopt the same price for you. No, I will tell you, look, I gave you the cloth, you do only stitching, you're doing only stitching. You cannot charge me anything more than the stitching. That is precisely what we look at from a builder's perspective. A builder is only constructing for the owner. And therefore, he is constructing on the land already belonging to the owner. It is only the construction materials and the construction related labor that should be relevant for the valuation is concerned. And therefore, one can concede by saying that the cost of construction plus a reasonable margin of 10% would be the best mechanism for valuation, which should address the issue as far as GST is concerned, as far as valuation is concerned. This is one comfortable method whereby the government also gets the revenue. The developer is also finding it easy because the selling price to the customer is a completely different selling price. And if you give an artificial 1/3 reduction, it becomes even more costlier. Last but not the least, subject to what the developer would like to do, most developers are not comfortable in taking this position. But there is one more position also available. This is an accounting perspective. Let's look at it from Mr. Leeladhar's perspective. He is a developer. He has constructed flats not only for market, that is his share of that goes to the customer. He has also constructed for the owner. And he has spent the same amount of time, energy, materials, etc. So whatever is the material cost and labor cost that he has incurred for constructing for the owner, it is all incurred by him and captured as part of his cost construction statement. And he has to recover this money from somewhere. And therefore, he fixes his selling price to customers in such a manner that this cost is all covered. So when he fixes a selling price to third parties, all this cost is captured in the arriving at the selling price. And on that selling price, he pays full GST. Therefore, one can argue to say that I've already paid GST on even the construction done for the owner because the construction cost which I've incurred is already captured in the selling price to other customers. This is based on a precedent from the Hyderabad bench of the tribunal in the case of Vasanta Greens in the service tax regime. And whether Vasanta Greens would be applied in GST or not is a separate topic, but there is a decision to say that from an accounting perspective, this cost has already been captured. But as I said, not many would venture into this proposition unless they have discovered that they have done the transaction, they have not paid the tax. Then it becomes a defense to argue that why tax is not applied.
Thank you, sir. I think now we can move on to our last issue and we can complete this session on this. This is on the disallowance of ITC on sale
Sir, I would like to take leave now because I have to go to some other meeting also. So please excuse me, Father.
Okay. Thank you very much, Maheshwari sir.
Thank you very much, sir,
for your nice and valuable contribution.
Yes. Thanks a lot.
Pleasure meeting you, sir.
Quickly, Amit, just complete.
Yes, we will just complete on this. Disallowance of ITC on sale of an under construction residential property. So in view of ITC on all new residential projects, whether pending writ petition before the Honorable Gujarat High Court in Hardcastle Restaurant Private Limited, that is McDonald's case. In similar case of restaurants has any persuasive role. And what if the landowner sell his share of flats during construction? Would he be eligible to avail ITC of the GST paid by a developer on construction service? Then definition of ongoing residential projects as per notification 3 of 19, whether it is appropriate. Then fate of a project which was in the middle of construction, but none of the units were booked before 31st March 2020, that cutoff date. And the last one, whether powers under section 16 and 17 are available to restrict the availment of ITC. So, Madhav sir, your quick view on this, yes, and then we can complete our session with this last part.
Yes, sir. So I will perhaps begin with the last part, that whether powers under section 16 and 17 are available to restrict availment of ITC. So under section 17, only and only the act says that banking sector's ITC is restricted to 50%. Where, like, if you go throughout the act, you go reading throughout the act, you will never find any section which says that the government has any authority to restrict anybody's ITC, any particular industry's ITC. But then this is being done. So this firstly happened in the restaurant case, as was introduced by senior Vethisan sir, that the government said that, okay, fine, we won't give any input credit and 5% would be the final tax on output. Here again it happened. So that is what is the issue, that certain real estate people want, that okay, you allow us ITC and we will handle our project in that manner. So I think that yes, it has been without the authority of law. Such restriction, such clear-cut restriction of ITC and disallowance is definitely without the authority of law. Then second part is that what is the fate of ongoing projects? When this notification arrived in 2019, March 2019, now they said that every builder has two options now. One, either he goes in the new regime where his ITC is disallowed, or he continues in the past regime where his ITC was allowed. If he does not take any option, it would imply that he has landed in the new regime. Instead of being a status quo, it was said that he would land up in the new regime of without ITC. Now, if my project is hanging in the middle, then how do I, and I have planned all my things. This disallowance of ITC is an added cost, definitely, and it is a huge cost of say 5% on residential properties. So like if I have not been able to sell any of my property before before 1/4/2019, then I would automatically land in the new notification, and my project cost would typically increase by 5% if I end up selling my project in if I end up selling some parts of my project before completion. So it would imply a direct increase of 5% in my cost for residential project. So again, it was very unjust. That was what was done. Then when we talk about this, what if the landowner sells his share of flats during construction? Now they have said that okay, the developer is billing the landowner on a notional value. Then will the landowner get the ITC of that figure that he has sold? Because the landowner will also continue to sell his properties, his share of properties, while under construction. So they have again given that okay, fine, they will give this facility to the landowner of availment of ITC, and provided the landowner charges the higher rate of tax. So again, provided that the landowner charges higher rate of tax from its customers. So like on the same project, it will happen that the landowner is charging higher rate of tax from customers, and the developer is charging lower rate of tax. So again, a lot of issues have been created by these series of notifications. So that is my point, that the government needs to relook into it by a proper enactment. I think a proper amendment should happen where all issues should be clearly addressed. Like in this manner, they cannot be handled like a hodgepodge.
I think we should now move to Dubey sir, and then the concluding remarks by Vithushan.
Just quickly, I think I agree issues are very challenging. Whether really the ITC of which is already given by the suit can be taken away by this type of notifications, number one. And number two, even this sort of notifications can be used as for disallowance or non-claiming. This is the very serious challenge. And whether this rate of 1% or 5% even get prescribed should be taken as the mandatory or optional. This is the basically serious challenges as raised. I think that times have to take settle, and a quick view we need from Vaitivaran Saab for the concluding view on this matter. Most challenging.
Yes, sir. I fully agree with Madhav. The powers are not conferred in section 16 or 17 to do this, and even if at all they could have contemplated restriction, they should have amended section 17 or linked to section 17 with the notification. Since it was not done, the notification per se cannot provide for a restriction in terms of ITC. As I said earlier, the notification refers to 16.1, but 16.1 does not give that power, and therefore it would be doubtful whether those restrictions can survive. Second, any restriction which takes away vested rights have always been frowned upon by the courts, because one thing is to say that prospectively you cannot get something, but another thing is to take away something which has been there from day one. And in fact, the GST 3/19 goes on to the extent of saying even your Tran 1 credit will have to be reversed by a cutoff date. And even the Rule 42, when it comes to completion certificate scenario, assumes that the common related service should be taken as nil for construction projects, etc. So all those aspects are definitely affecting the rights which have been availed in the past, and therefore they are definitely germane to challenge. And the principles, the challenge in the context of hard causal is equally relevant in the context of construction. And therefore, whether a person has got a right to say, I don't want the 5% because I want ITC. Can I not go by the full rate and pay the tax and get the ITC? And that would be based on the principle that, one, it is a conditional notification, and therefore if it's a conditional exemption notification, it is not binding, it is not mandatory. So that principles which was there in the old regime would all come into play. In fact, it is very funny that, a law can be so complex. Of course, as lawyers, all of you would agree, all of us would agree that the complexity of the law has also contributed to our bread and butter. But sometimes we wonder as to why it should be so complex. Just because it's construction of complex doesn't mean it has to be complex. It is one of the critical sectors of the country, and it deserves a much simpler tax regime than this. For example, if you take jewelry, they enjoy a very good simple tax regime. There is no complication as far as the rate of tax is concerned, no big disputes and things like that. So I think we somewhere the government should also think through simplicity of law would result in much higher compliance, because I know for a fact that many builders and developers and landowners are clueless, and in that process they make a lot of errors, and those errors become costly over a period of time. So that's where the simplicity in law. So I would conclude by saying that none of these notifications are something which are easy or something which can be easily understood, and even professionals differ in their thought process, and there are a lot of divergent views as can be seen from the market articles. You'll find that the contrary views emerging on day one, on every day, and therefore it is probably high time that the government rethinks the entire tax regime for real estate sector and tries to make it as simple as possible, so that they get their fair share of revenue, they get what is taxed as the service portion, and landowners are not unnecessarily burdened. Because one more thing is important here is, when you say that development rights are taxable and the reverse charge mechanism is applicable in the developer hand, you are indirectly saying that the landowner has made a supply of service. And for him to make a supply of service, it must be in the course or furtherance of business. So for the landowner, a 90-year-old landowner getting into a joint development agreement to get his old house converted into a complex, he is not in a business activity. He's not carrying out, he's probably settling property for his grandchildren. Therefore, if it is not a supply in his hands, can it become a supply in the hands of the developer under reverse charge mechanism? It's a very important question. With that, these are my concluding thoughts as far as this topic is concerned, but very brilliantly presented as questions and beautifully analyzed by all the panelists.
Thank you very much, sir. Amit, I think we are already 6:30, and if you can have one or two some immediate questions, otherwise the questions can be responded by Mr. Madhav over the mail to concerned parties. But quickly, if something is for Vaiti Isran Saab, you can quickly take those questions.
Yeah, I will just take some questions, and I think participants can mail their questions, and we will just answer it.
I think.
Yeah, there is Miss Aarti Mahajan. She asked that, can it be said that TDR against receipt of certain constructed flat amounts to a barter transaction?
Vaiti Isran Saab.
Yeah, we would need another 2 hours to discuss this. Seriously, because barter has been understood as barter between commodities and has always been kept out of the tax range. Now we are now debating whether there can be a barter in a cross-referencing format. Can goods be a barter for a service and a service be a barter for goods? And if so, are both taxable or only one is taxable? Those kind of open issues are there. And unfortunately, the law gives no guidance on that, and the language is quite open. It's a definite topic for debate by itself, I believe.
Next.
Thank you, sir. I think we can conclude on this. Mr. Sandeep is added for presenting vote of thanks. I think we have taken a lot of time of the panelists.
Last but not the least, I, Sandeep Pandey, on behalf of JMVD Legal, take this opportunity to thank the panelists, Shri K. Vaiti Sharan ji, Shri Vian Dubey ji, Shri Leeladhar Maheshwari ji, Shri Madhav Tulsian ji, for enlightening us with a wonderful panel discussion on joint development agreement issues under GST. I also thank all the participants for being patient listeners and for bringing forth the enlightening questions throughout the session. This would not have been possible in absence of any of you. I also thank Team JMVD Legal, Credai Indore, Indian Lawyers Association, and Law Internship for organizing such an enlightening session. Thank you, everyone.
Thank you, everyone. Good weekend.
Thank you very much. And we need your continuous guidance.
My pleasure. It's been wonderful interacting with you.
Thank you. Thank you very much, sir. Thank you.
Thank you, sir.